Good afternoon and welcome to the Asian Midday Market Watch, powered by Rajhi Bank Malaysia. Today we welcome Jeffrey Halley, Senior Market Analyst, Asia Pacific at OANDA, as our guest. Good afternoon, Jeff.
Good afternoon, Brian. Always a pleasure, mate.
Now, mate, before we get your insights, let's take a look at how markets are performing, starting with crypto markets and then going across to regional stock markets. Bitcoin is at 40,866. It's up 5.27%. Ethereum is at 3,047.53. It's up 4.68%. Now, markets are all back open, and we'll start with the Singapore Stock Exchange. The SGX is at 3,321.75. It's up 0.57%. Now, looking across to the KLSC in Malaysia, it's at 1,500. KLSC is actually closed today for a public holiday. Shanghai is at 3,201.17. It's up 0.18%. The ASX is at 7,872.64. 72.00. It's up 0.64%. The Nikkei is at 26,988.5. It's up 0.7%. The Hang Seng is at 21,138.5. It's down 0.79%. And rounding up the numbers, we've got the Kospi, which is at 2,717.69. It's up 0.91%. Now, what's your view, Jeff, on how markets have performed this morning?
Yeah, I would say modestly positive. We've saw some comments overnight from Fed President James Bullard. He's quite a noted hawk, suggesting that there could be 75 basis point FOMC rate hike, Fed fund rate hikes, and that the neutral rate of funds could have to be as high as 3.5%. That took the heat out of the rally that we saw in New York overnight after very strong results from Bank of America, and markets there closed around sort of unchanged. The market seems to have put that news behind it in Asia today, and futures on all three major indexes, notably the Nasdaq futures, have rallied quite strongly, and that set Asia up for a fairly positive session. We've seen South Korea's Kospi and the Nikkei perform very well. Also Australia and Singapore, Malaysia, the Philippines and Bangkok. China is a bit more mixed. Shanghai Composite is slightly in the green, but the CSI is in the red. And I think it's this perpetual concerns now about growth fears that are really weighing on markets on the mainland, and it can't really shake that funk off. And it's probably going to need some concrete steps from the government to really do that. Hong Kong is the outlier today, down nearly 2%. And I think that relates to delisting fears. Some Chinese companies are voting on whether to delist their ADRs from the US. That could result in less investors on the share register and less liquidity. And I think markets have fallen in sympathy because of that.
Now, Jeff, overall, the data out of China is retail data came in below expectations. First quarter GDP was higher than expected, but essentially, and then People's Bank of China announced also it will increase its financial support for industries affected by COVID-19. Now, against this backdrop, we've obviously had from last year sizable outflows from Chinese equities, basically reflecting overall de-risking out of China. What's your view on all of this confluence of data points and events?
Yeah, there's a perfect storm here. For a start, although it's off the headlines, it's still a very real issue, and that's the property developer leverage saga, that slow-moving train wreck of companies such as Evergrande. That problem is being exacerbated by the COVID zero policy of the mainland government, which has obviously shut down Shanghai, but has also impacted a number of other cities across the mainland. The fears there that, I mean, this lockdown's gone on for quite some time in Shanghai. If that spreads to other major cities and they enter lockdowns as well, extended lockdowns, that must impact China's growth outlook. And on top of that, we have the ongoing regulatory threats from the government as far as clampdowns go, notably in the tech sector. There's no sign that that's over. So it's this confluence of events combined with falling growth because of the Russia-Ukraine conflict, with those soaring inflation of base materials, etc., and port blockages in China. This is all coming together to weigh on China markets, and I think this is going to be the case until we see the Chinese government really come out and start pushing the stimulus button.
Now, Jeff, what are some of the key points that you've highlighted in your commentary today that we should be watching out for?
Yeah, look, I think it's interesting about the central bank choices around the world. Now, there's starting to be a real divide now between Anglo-Saxon countries, if you wish to describe them as that. Very high inflation, central banks well behind the curve on transitory versus entrenched inflation. No good choices there. You can either hike rates to dampen that and cause probably a slowdown, if not a recession, or you can let inflation run hot. Costs and prices rise, citizens' pricing power gets slammed, and you could have protests and social unrest. Asia and Europe, by contrast, because of very different reasons, are starting from a lower base of inflation, but still have those same issues. They're more likely to let inflation run hot to keep the lights on the economy, whereas the Anglo-Saxon side is more likely to be hiking rates, potentially enacting a slowdown. So my commentary is mostly about those very unpalatable choices that many central banks have. And I think one of the first ones we'll see today will be the Bank of Indonesia this afternoon with their latest policy meeting, and whether they choose to keep rates unchanged and let those core inflation and inflation components continue to creep higher to keep the recovery going.
Now, Jeff, as always, thank you very much for your insights.
Always a pleasure.
Now, we've been speaking to Jeffrey Halley, Senior Market Analyst, Asia Pacific at OANDA, on Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as Rajhi Bank's social media platforms. Please subscribe and like our various platforms. Thank you very much for tuning in.